Hey guys, welcome to another video from Shaysky TV. In this video, I'm going to go over whether or not I think Amazon stock is a buy at their current stock price of over $3,000. And to do this, I'm going to go over their business model, their stock fundamentals, their strategy, and last but not least, the risks. This is just my own personal opinion and analysis. Also, make sure to do your own analysis on your risks and your own comparative advantage. If this is your first time hearing the words comparative advantage, make sure to also check out my other video with a link in the description below. Amazon was founded back in 1994, and during that 90s period in the early 2000s, Amazon's only sizable competitor was eBay, who was founded in 1993. And during that time, there was no other competitors exist in the e-commerce market, so both of these companies were venturing into a blue ocean market. Now let's dive into their business model. Amazon is a large tech company that have two types of services that generates their highest revenue. Number one is their e-commerce platform and supply chain. Number two is their AWS, Amazon's Web Services. Amazon's e-commerce business has a multi-level sales strategy. They implement both a business-to-consumer model and a business-to-business model. In the business-to-consumer model, Amazon supplies their own products and platform and sells their items to the customers. In the business-to-business model, Amazon lets third-party sellers to host their items on Amazon's platform and takes a profit once that third party manages to sell an item to the customer. Amazon also manages their own supply chain and logistics, meaning they have these massive warehouses called fulfillment centers where they store supplies from their suppliers or items from their third-party sellers. Then Amazon delivers them to the hands of the customers. There's also an affiliate program that allows anyone to post links to items from Amazon, and that person will earn a commission if anyone clicks on that link and buys that item. The platform where buyers can become sellers and sellers can become buyers creates a sustainable and efficient network effect that allows the user base to expand bigger and bigger at a really fast pace. And due to the low barrier of entry, users will attract more users, and Amazon will enjoy the demand-side economies of scale, where added participants creates value for everyone in the ecosystem. And as the user base increases, it allows more data to be collected to improve their services. In the e-commerce business in the United States, Amazon currently have a 49% market share. However, that is only 5% of all retail spending across the entire country. E-commerce spending is expected to increase into 2023, so I personally believe that Amazon has a lot of room for growth and continue to expand the pie. Amazon's AWS business is a subsidiary of Amazon, providing on-demand cloud computing platforms and APIs to individuals, governments, and corporations. This is also a B2C and a B2B business model because this service can be used by both corporations and individuals. AWS was launched all the way back in 2006. Can you guys believe it? That's just 10 years after launching Amazon. And it was a complete blue ocean at that time where no other competitors in the cloud business exist. And later on, this market was followed by Google Cloud in 2008 and Microsoft Azure in 2010. Since Amazon was the first to market in the cloud business, along with making all the right decisions to focus and build it up, AWS is currently dominating the cloud business at a 33% market share, followed by Microsoft Azure at 18% and Google Cloud at 9%. I think this is phenomenal, and I think cloud users will continue to grow, and due to the network effects and demand-side economies of scale, the more users that uses AWS, the more value the service will bring to the customers. Now that we know more about Amazon's two biggest growth pillars, let's jump into the company's stock fundamentals and financial highlights. Amazon's stock price at the time of this video is trading at $3,311, which is down about 6.8% from its all-time high of $3,552. Its 52-week low is $1,626, which means that this stock have doubled sometime over the last year. Since the price of the stock doesn't necessarily translate whether the stock is cheap or expensive, let's look at some fundamentals. Amazon's market cap is currently trading at $1.5 trillion, making it the second largest company by market cap behind Apple. Their revenue has been growing exponentially since the last 15 years, and this to me is very impressive. They have just reported their Q3 earnings, and they have achieved a Q3 revenue of $96 billion, which is a 37% increase year over year. Their net income has also grown to $6.3 billion this quarter, which has been tripled since last year's Q3. Both of Amazon's revenue and net income has been on an upward trend, and based on their earnings presentation, their long-term goal is still to optimize free cash flows. As you can see on this chart, their net income is a small percentage compared to their revenue, meaning they're using a significant portion of their revenue on operating expenses. Based on their latest annual report filings, the North America segment, which includes e-commerce and other services, generated 60.9% of revenue and at a 21% annual growth. Their international segment generated 26.6% of revenue and at a 13% annual growth. Lastly, the AWS segment generated 12.5% of revenue at a 37% annual growth. Amazon's price-to-earnings ratio is trading at 95, which is much higher than the S&P 500 average of 35. Their price-to-sales ratio is 4.83, which is almost doubled from the S&P ratio of 2.56, but a ratio of 5 is more aligned with the industry's average. Their price-to-book ratio is 20, where the S&P 500 is at 3.89. If we just look at these price ratios, it tells me that Amazon stock is not cheap compared to the average company in the S&P 500. But this doesn't illustrate everything. Let's keep going and look at some company financial ratios. The current ratio, which equals to current assets divided by current liabilities, is also defined as the liquidity ratio that measures a company's ability to pay short-term obligations. Amazon's current ratio is 1.11, and you can see on this chart that their assets are growing as well as their liabilities, which indicate that they're still on a growth stage. Since the ratio is greater than 1, it means that they have more current assets than current liabilities, therefore it demonstrates their ability to immediately cover their current liabilities. Amazon's debt-to-equity ratio at the time of this video is 0.99 and is calculated by dividing the total debt by the total shareholders' equity. This ratio is often used to evaluate a company's financial leverage. Having a ratio below 1 means shareholders' equity has the ability to cover all outstanding debt in the event of a business downturn. Next, I want to look at some margins. Because Amazon have really high operating expenses of nearly $266 billion versus a revenue of $280 billion, which, by the way, operating expenses is broken down by cost of sales, fulfillment, technology and content, marketing, general admin, plus other expenses. This means Amazon's operating profit margin is only 5.18%, and their net profit margin is only 4.13%. This is on the low side, but I don't think it's something to be concerned about. If we just look at the gross profit margin, it's about 41%, which is on the more reasonable side. If we just look at financials, Amazon is a beast. Their revenue is growing double digits year over year, and their net income is also growing significantly year over year. The only thing I would say is that their stock price is not cheap, but I do think there's a good reason for this. And why I say that is because the present stock prices is always driven by the company's future cash flow. In other words, it's how much money Amazon will bring in the future. Now you're gonna ask, how am I supposed to know how much money Amazon will bring in the future? Let me answer that by unfolding the next part to this video, strategy. Strategy, by definition, is the goal-directed actions a firm intends to take in its quest to gain and sustain competitive advantage. The key word here is sustain. Ever since Amazon's early days in the 1990s, Jeff Bezos has been implementing a customer-driven culture and strategy because he understands that customers drive long-term profitability. This can be seen in Amazon's annual shareholder letter where he wrote in the long view, interests of the customer and shareholders align. As an Amazon customer and shareholder, I value the way that they treat their customers and the decisions that they make on a daily basis. These decisions include spending capital on innovation and growth to provide even more opportunities and value. In the recent years, these include Amazon Go stores, electric delivery vehicles, hosting Shark Tank items from their websites, buying startup companies like Ring, buying physical stores like Whole Foods, expanding internationally like their recent $100 million investment in Mexico, plus many other countries in the past. They're also investing in entertainment such as their Prime Video, making their own cloud-based gaming services, and also developing their own games. By the way, I'm not a huge fan of their game Crucible when it was released early in 2020. I tried all the characters, but I just couldn't get into it. And based on the feedback online, it seems like I'm not the only one. So it can be concluded that making video games is not one of their core competencies. However, one of the good decisions that they made was to recall the game back into beta once it lost steam. But this is something that I'm going to keep an eye on because I think the entertainment industry is the next big thing, and I think there's a lot of growth opportunities in this space. Anyways, it's not exaggerating to say that Amazon is taking over the world. And for myself as an investor, I believe these investments will create long-term value because I trust that when Amazon invests in something, they're not going to give up halfway and they're going to put in however much effort they need to in order to do it well. In addition, I think their critical, time-sensitive, short-term decisions are also aligned with their long-term strategy, which, by the way, it's much easier to make short-term decisions when you have a long-term vision. And these short-term decisions I want to highlight is what they have done in the middle of this pandemic. And there are 3 decisions that they made that I think that will provide a lot of long-term value and differentiate themselves amongst their competitors. Number 1, they do not hesitate to spend money even at the cost of losing profitability. In June 2020, Jeff Bezos warned investors to brace for losses as they plan to spend $4 billion in COVID-19 related expenses. Number 2, they have urged shoppers not to buy on Amazon due to the increase in demand. And this is the first time ever in Amazon's history where they told customers not to buy. I think this point should be highlighted a lot more because the other option is to let demand continue to increase and later on disappoint their customers. So between these 2 options that they had, the decision that they made brings the highest opportunity value in the future. Number 3 is from a customer's perspective. So unlike other retail stores, when something is out of stock, Amazon actually labels that item out of stock. The cherry on top is because a lot of people are sitting at home right now due to the pandemic, they're somewhat forced to do more online shopping. So this situation not only adds a short-term boost, but also creates long-term value for Amazon. Remember, Amazon only have 5% of all retail sales across the country, so a lot of these are going to be new customers who will eventually be converted into Prime members, if not already, and continue to stick with shopping on Amazon in the future. Overall, my opinion is that this pandemic probably, possibly, most likely added $1 billion to Amazon's brand name. Lastly, I want to talk about risk. Based on their customer base and financial statements, I personally don't think that there's a risk of bankruptcy or a potential event that will cause the boat to sink. I think most of the risks comes down to whether Amazon can deliver the numbers to meet investors' expectations. For a growth company, investors are going to be looking for a high growth on earnings. So if you're a short-term investor, there could be a higher volatility, especially during earnings seasons. If you're in for the long term, I think this is a great growth stock to buy and hold. I personally place this stock in my high to medium risk bucket in my personal stock portfolio. Amazon's currently 30% of my stock portfolio since I'm only focusing on building high to medium risk buckets. I've been holding this stock since 2017, and I've recently added some more shares when it dipped below 3,000. I think it's a great company to own for the next decade. They have a huge advantage over potential competitors as they have the biggest market share in the e-commerce and AWS space and continues to expand the pie. The more they grow, the more data they can collect to improve their services, and the fuel to that growth is their obsession on their customers. I personally have the confidence that they will continue to make great strategic decisions to provide long-term value for their customers and shareholders. That's it for this video. I hope you guys enjoyed the content, and if you did, make sure to hit the like and subscribe to my channel. Let me know in the comments below whether or not you think Amazon stock is a buy, and make sure to check out my other video on investing strategy.